Today's episode is brought to you by Bit.com. You'll be hearing more about them later on in today's interview, which begins right now. My next guest needs no introduction, yet he shall have one. Ed Harrison, senior editor at Bloomberg and publisher of the Everything Risk. Ed, welcome to Forward Guidance.
Thank you very much, Jack. It's great to talk to you again. And I see you have a nice mic. And now I realize I was like, that's what I'm missing from the days when we used to do this kind of thing all the time. I don't have a mic.
Yeah.
And I'm upstairs in my living room versus in the basement when we used to do it before.
Oh, wow. So some things change, a floor or two of difference. Well, Ed, as you said, we go way back, so we know each other well. We haven't caught up in a while, and we haven't talked markets in a while. So I am really jazzed to do this.
Yeah, so am I. So lots to talk about, lots of volatility, lots of different markets that are at play as well.
Yeah, right. So Ed, I'm just going to, I was reading your most recent piece from the Everything Risk. And you say that right now we have the makings of a new era for the markets. Ed, you're not someone who's given to hyperbole. So when you talk about a new era, I'm paying attention. Why is this a new era?
Yeah, I think that because the old era was dominated by zero rate and accommodative policy. If you think about where we were, we hit the zero lower bound and we basically couldn't get off it except for that very short period of time between 2015 and 2019. And that was a traumatic experience trying to get off the zero lower bound. We exited out of that and went the other direction, and the pandemic came. So basically, since 2008, 2009, we've been in this unbelievably easy monetary situation. And so now with the Fed tightening, and because of inflation, and I believe that inflation is embedded, it's becoming embedded in a negative way. That last CPI print that we got on Wednesday, which is actually today, but it'll be tomorrow when this goes out, tells you that. That tells you that the Fed can't relent, and there's political pressure for them not to relent. So we're in a new era, and that means very different things for the market than the last 14 years.
Right, Ed, we should say today we're recording on Wednesday, May 11th, when the US CPI was announced 8.3% year over year increase versus 8.1% that was expected. So definitely a hot reading. Ed, the past 14 years of easy money, how did that shape the equity markets, the types of companies that went public and the prices at which they were valued? And how might that change if we're moving into a era of less easy money?
Yeah, a good question, because I look at even during the dot-com bubble period, if you go back to 97, the levels at 97, this is pre LTCM, that was sort of the low during the next phase. So I'm looking at 97 to 2013 as a block during which we were range bound, even though 2013 was 5 years into this 14-year period that we're talking about. So the market was range bound between, say, 700 on the low. You get the 666 number in 2008 that on the S&P, 2009 on the S&P, but 1,500 or thereabouts on the high. And so basically, if you got into the market near the highs during the dot-com cycle, you didn't make any money for another 10, 12 years. And so when you take inflation to an account, really your negative returns are very large over that decade. Then you look at a chart and you compare that to the 14-year period that we're talking about. Let's make it 16 years to go back to 2006 to get it consistent. And what you really see is, even though we had that little hiccup through 2009, is just up and to the right. So what I would expect is that aberration of that up and to the right, which is coincident with the easy money period, to fade away, and for us to look more sort of like we did in the period before that. And remember that was a period during which inflation wasn't a really big problem. So if you add the fact that inflation could be a problem, and therefore the Fed could be more aggressive even than then it's not just a range-bound market, but one in which returns over a longer period could be negative.
And Ed, you were working on Wall Street back during the dot-com bubble. How does the excesses, if I can call them that, while still maintaining my objectivity, the excesses that we've seen today of stocks that are going public are price to sales of 100, or they have no sales whatsoever, or they have deeply flawed business models where they can grow a lot, but it costs them a lot of money. They're losing a lot of money. They're using, funky metrics like EBITDA and community adjusted EBITDA. How does that era, which perhaps we're witnessing the end of right now, how does that compare to the dot-com bubble where you had, kind of the similar things, but with pets.com and stuff?
Right. Yeah, I think that the era in public markets, i.e., public equity markets, was worse back then than it is today. However, if you include crypto into that, that is, let's use Dogecoin as a perfect example, which was, the algorithm is similar to Bitcoin, but it was a joke to begin with. And, you have unlimited supply, and it makes crypto look bad in certain ways. From my perspective, when you see sort of the speculation there, that's where the speculation is. So in the old days, you got all these little companies going public. Today, all of those companies aren't going public. They're just getting VC money. And it's only later that they go public. But if you want to get access to early stage stuff in the way that you did back in the dot-com bubble, you have to go into the crypto arena, because there's all sorts of things that are happening within the crypto arena, which are early stage. People are trying to get in there before we find out who the market leaders are in the next cycle. And that's where potentially you can get hurt. That's where the excesses could lie. Right.
And you said companies are staying private for longer. I know that was a huge hallmark of the past decade, because companies like Uber, which were huge, valued at $60 billion, they were still private. But at some point they had to IPO, and they did IPO. Uber IPO'd, Lyft IPO'd, and that gave wave to the sort of SPAC boom of speculative companies, i.e. non-profitable companies, in some cases non-revenue companies, let that sink in, who went public. And for a while, maybe let's say in the summer of 2020, it seemed like there was hope in the air. Yes, we're in a new age. Those companies, what is revenue? What is profit? Come on, Ed, you're so old school. It's all about the future. It's all about, this and that. And yeah, that has seen a huge repricing. What do you think? What do you make of it?
Yeah, so I'm a believer in crypto. I'm a believer in the exponential age. However, I think that both of those things are associated with busts. They're associated with speculative manias and then busts. Why? Simply because we're at the next level of technological displacement. Crypto is an arena of technological displacement. If you don't get in there very quickly and get the network effects that are going to accrue to you and make you hugely valuable relative to your competitors, and then basically block them out, then you are not going to have a chance. You got to do it immediately. And so what that means is everyone and his brother is getting into the space. Everyone and his brother is getting into other spaces of technological displacement. And there's going to be a shakeout at some point in time. When the Fed raises interest rates, when a capital investment is withdrawn, those companies that haven't made the grade yet, those will be busts. And many of the other players will go on to huge, great things in the future, but there's going to be a lot of carnage between now and then.
And how far do you think that carnage will go? If you look back at the 2000 bubble, I think it started to pop in maybe May of 2000, and you had some carnage for 5 months, then it sort of relented, and then some people thought, oh, now's the end, now's the time to buy the dip, but it wasn't. You had like a year, maybe 2 years more of a huge drawdown, and it wasn't just the speculative names, it wasn't just the pets.com that got annihilated. It drew down the generals of the market, Cisco, if you will, AOL, although I don't know if that merger had happened, but Walmart as well, sort of consumer staples as well. So can this, ARK is down big, it's sold off 75% from its highs. Is it going to drag down Apple? Is it going to drag down Microsoft? What say you?
Yeah, I think that the whole we've already seen, the Nasdaq's off 25% already in this year, so it's definitely already dragged down. The question is will it go further, and how much further will it go? I think Cisco is a great opportunity to look, because it was a market leader, it was a real company. It was actually already in the early 90s, after the Fed raised interest rates in 94. Cisco started to take off, but even before that, it was recognized as the next hot area. And yet here we are today, and we're really at levels that are commensurate with the levels of the late 90s. So Cisco price earnings ratio was just tremendous, and as a result, it treaded water for the next 20 odd years, even though it's an amazing company. Tesla is a perfect example of that. Here's a company that is pricing in a ridiculous amount of growth over time. Basically, it has to execute perfectly over the next 20 years in order for that growth that's priced in to be warranted. And so it could be the next Cisco of this particular era. As for Microsoft and Apple, at a minimum, their price earnings ratios are lower, so they have less to fall, having already fallen, say, 20% now. So I think that they have been hit. They will continue to be hit, but they'll get off the ground much quicker than Cisco did back in the day, and Tesla will today.
And what happens, Ed, to companies that are richly valued because they grow quickly? What happens when they start to go X growth, when they stop growing?
I was at Yahoo back in the day. I left banking to go into the internet just as it was busting. And there's a thing called operating leverage. And we can talk about the exponential age and Metcalfe's law. They're both of those things are very related. So operating leverage says that when our revenue grows, the costs don't grow at the same rate, because we have that operating leverage. So, revenue grows at 7 times over a period of time, but costs only grow at 2 times. So you get a massive amount of money that's falling to the bottom line. The problem, however, is if that growth doesn't materialize, there's a recession, and it not only does it cause growth to diminish, but potentially for you to start, throwing in some negative numbers, shrinking slightly. That operating leverage works in reverse. So it magnifies the decline, and therefore all of the projected growth just tumbles out in a magnified way. So that's what gets you the 50, 75, 90% losses in the market cap. And when we think about it just from a network effects perspective, network effects say that there's an exponential increase in the value of your network as the number of people get drawn to the network. And we have Mark Zuckerberg as a perfect example of that with Facebook and with Instagram. However, it works in reverse. If there are a lot of people in your network speculatively, if those people are exited out, then suddenly your network loses value at a more rapid rate than the loss in the size of the network.
So Google, Facebook, yes. Someone joins Facebook, the network is more valuable. Ed, you join Facebook, you join Twitter. My experience on Twitter is bolstered because I get to read your tweets and interact with you. But if you're on DoorDash and suddenly I'm on DoorDash, that's not a network effect. That should not be valued richly. And if you look at the stock, DoorDash came public where those network effects were valued quite richly, price to sales very, very richly. And those have come down to earth. I'd also add perhaps Carvana to that list where these stocks are down at 70, 80, 90%. I mean, Ed, I'll just be honest. There was a stock, I won't name what it was, but it was an online retail stock. It was at $25 and then it went down to $6. And I said, you know what? I'm a pretty smart guy. The stock was at $25. Now it's at $6. If it goes back to 25, that's a pretty good return. I'm gonna buy a little bit of the stock. And then it went down to $5. And I said, you know what? It's even better. I just sort of was kept on averaging down. And now it's at a little bit over $1. So I have learned the hard way. Fortunately, it could have been much worse. But I've learned the hard way that stocks that go down 80% can go down 80% again.
Right. I mean, and it's funny. I think Joe Weisenthal, he was like, a stock was down 90% and then it was down another 15%. He was like, I didn't even know that could happen. A stock could go down 105%. He was joking, but once you're down 80%, you can still go down another 80% as well, which is the equivalent of 90 some percent as a result. The interesting bit, however, is that I think there is some degree of network effects in market clearing type of places, like let's call it search or Uber or DoorDash. So if more drivers get on board, then more people will get on board. So there is some sort of, you have to have both sides equaling one another, and therefore there's a weaker network effect. And so to me, it shows you that there are places where the network effects like Facebook or Instagram are stronger, and then there are other places where it's weaker. A perfect example that I always use is Amazon. I was looking for something that was like a recovery agent because I like to go out on my bicycle and sometimes I need to recover. I went to Amazon to find the good. Why? Because Amazon, in my mind, is like the Google of good search. So why is that? It's because everything is on Amazon. We've gotten to a point where Amazon there's a network effect associated with that.
Yeah, Ed, I think you're totally right about Amazon. That does have network effects. The delivery business, the profit engine is AWS, the Amazon Web Services. But I think you look at that retail business, it's not going to ever really be a huge profit engine. I mean, it will based on the sheer scale in terms of tens of billions of dollars. But in terms of it's not going to have a 60% margin, let's say. There are some businesses like, let's say, the iPhone or maybe Google or Facebook that are just incredibly profitable business. They just print cash because they just generate so much money. But I think the delivery business, where delivering food to people's homes, that should not be valued at a multiple where, okay, you grow to a certain level and then you become profitable and then you are really profitable. I think a lot of businesses have been valued as if they're technology companies when they're really sort of plain old vanilla businesses,
Right. Yes. That's what's going to come out of this market. As the interest rates, as we normalize interest rates, when we go back to the regime, the era that we had pre-zero rates, you'll see a lot of the expectations for those kinds of businesses go away. So that's what I expect to happen. And I think it's a longer term process. If you think of where we are right now, if you think perhaps we're in a bear market, there are bear market rallies, and that goes on for a while. And I think that the overriding consideration is monetary policy, especially in the United States, because the Fed has already said what it's going to do. I think that the level of restrictiveness is going to be too much to handle just from a real economy perspective. And so all of the dynamics that we're talking about are going to gather pace, in addition to a loss of capital investment, bankruptcies, spread widening in the credit markets, et cetera. And all of those things will hurt multiples. It will hurt especially these businesses, and you're going to get a rotation back into value as a result of that. And these businesses that we're talking about, their multiples are going to come down as a result.
Before we move on to the Fed, ARKK, ARK Invest Fund, is currently trading at about $40. I believe its low during March of 2020, the COVID crisis, was somewhere around $33. Ed, do you think it reaches that level? And if so, does it become a buy?
It does. It's hard for me to say if it does become a buy because I don't know the constituent parts well enough. I can just talk from a pure momentum perspective. I think that the real problem for ARK is the concentration and also the fact that it is people might pull their money out from a momentum perspective. So when you have a concentrated portfolio like they do with 30 some stocks, and these are somewhat illiquid stocks, once the tide turns and people start selling and you get these redemptions, then it becomes very difficult to manage that just from a pure flows perspective, because then you have to start selling your good with your bad, and then it just creates a crescendo down. So I think that ARK is in a very tough situation. If the macro environment that I'm talking about is true, then you're going to see those dynamics play out, and therefore, those levels, we'll see them hit those levels and more, because people are going to rotate away from the companies that are in that portfolio.
And what was the macro backdrop of the past 2 years that was so favorable for ARK? Low interest rates from the Fed, stimulative fiscal policy as well. Why was that so stimulative to let's say, ARKK? And moving on from ARKK, what's different about it? And perhaps can you go into why higher interest rates are bad for sort of long duration stocks as well as bonds?
Over the last 2 years, basically, I think what you had was a full bore fiscal and monetary stimulus. So if you looked at 2018 to 2019, we got to a point in December 2018 where the credit conditions were poor enough that the Fed relented, and then they started to backtrack. That was playing out just as the pandemic hit. And so could we have gotten a soft landing? Maybe. Would it have been a recession? It's hard to say. So, but then suddenly full bore reversal of policy, and that delayed the reckoning that we were experiencing in 2000 and the early 2020. And so the last 2 years have been sort of, if you go back to the .com period, it's sort of that LTCM Asian crisis period. That is, you were starting to see a little bit of a correction, and then the Fed back then reverse course, and that allowed you to have the ultimate blast off. And so that's what we saw over the last 2 years. And unfortunately, that also means a much more restrictive Fed. Just like back then, we saw a final 50 basis point hike. Now, because of inflation, we're going to see 3 50s in a row. And so it could be, and I would predict it will be worse in many ways in terms of the outcome.
So we've got the Fed funds rate went from 0 to 75 basis points over 2 meetings, and it's projected 50, 50, 50 hikes. So that would be 125, 175, 225 in just 3 FOMC meetings. You said you do think that's going to happen. Tell us how you think that's going to shape markets. Is the market going to react? Because the market sold off so much before this has happened. And then also, what do you think will be more deleterious to markets, the rate hikes or the quantitative tightening, the reduction in the Fed's balance sheet?
Yeah, so I think that the markets can only price in so much in terms of what's going to happen, because we can't see into the future. But what I think is going to happen is we're going to get the reality check in terms of credit distress, and also we'll get a reality check in terms of the mortgage market. And so I think that we'll see a lot of slowing on both of those things. That is, people who are looking to refinance, to re-up. There's going to be more distress there because of the levels. And then we're also going to see in the housing sector, we're going to see a slowing. We've already seen that slowing. We've already seen some level of distress. If you look at junk, triple Cs, which are the lowest non-default, non-distress ranked high yield bonds, they've tanked under the onslaught. But we're going to see it accelerate. So I think that the real economy for those most vulnerable, those companies most vulnerable, that's going to be more difficult for them in the coming months.
Because they'll just have to pay a higher rate on their bonds, both on a risk-free basis as well as the credit spread on top of that.
Exactly. And so I think that you're going to see more distress. And once that distress seeps in, then that's when the slowing will begin. And the markets can't fully price all of that in. There's still the potential that inflation relents, that the Fed doesn't do the 50 basis point hikes, et cetera. So it's not fully priced in. It will only be fully priced in once it happens.
Right. And Ed, you said you're starting to see some distress in the triple Cs. The yield on the triple Cs is going to 10%. That does sound bad, but one might argue, hey, you're lending to highly junk grade, it's like kind of the lowest grade credit there is. You should be getting a 10% yield. The fact that you would get only a 5% yield or a 7% yield is a sign of a monetary disorder, overstimulation. And, I think triple C's in terms of yield to worst went to 35% in 2008. So there's a yawning gap between crisis and where we are now. And looking at high yield, the less junky side of high yield, less risky, I should say, I feel like a lot of that, the sell-off, let's say in HYG, has been in the risk-free rate rather than the credit spread itself. So, I'm a novice in the credit markets, Ed. I haven't worked there professionally like you. You had a blog called for a long time, Credit Write-Downs. Am I wrong that so much of the stress, that we haven't seen nearly, we haven't seen that much stress in the credit markets so far?
Yeah, I think that's definitely the case, and also, just going back to December 2018, we still haven't had that event yet. That credit event, enough of the deterioration in the credit that it causes the Fed pause. So we're definitely not there yet. The credit spreads haven't gapped out enough. It hasn't hit the triple Bs. And interestingly enough, I think I saw Marty Fridson, who's a high yield analyst. He's a specialist there. Everyone knows. He was talking about the default rates that we're seeing versus what Moody's, that the default rate that's implicit in the spreads is less than what even an analyst like Moody's is saying they expect in the market. So if there's that discrepancy between the actual price, the implied default rate, and the default rate that Moody's, the ratings agency, is projecting, then you have to get that price up, the risk rate up, or the Moody's rate has to come down. I think what you're going to see is that this is going to go up. It could be that Moody's then goes up and it goes up even more. So all of that's going to happen, and it's not going to happen in a glide path way. December 2018 tells you that it happens in a crescendo kind of way, and then that's when you get the 30%. I think that you were talking about, things of that nature. These discontinuities.
And roughly, Ed, how tight do financial conditions have to get in order for the Federal Reserve to be successful in destroying demand and lowering inflation? It's pretty clear that a 4.5% high yield spread, what we have now, is not going to do it. Are we looking at 6%, 7%? Likewise, on the S&P, is a 3,700 on the S&P 500. What's that? Roughly a 20% sell-off. Is that going to be sufficient, or do we need to go lower?
Yeah, it's hard to say. I mean, it's anyone's call, but I think in terms of what the Fed is saying, it's interesting. There were two Fed officials yesterday that I listened to that I thought were interesting. One was Raphael Bostic of the Atlanta Fed, and he was talking about, he thought that the cadence, he used that term, was good, that they were on, i.e. they did 50, meaning I thought implicitly he was suggesting they're going to do more 50s. So 50, 50, 50. And then he said, we'll just have to see what the markets say, as if there was an implicit put, meaning we're going to do 50, 50, 50, but if the markets fall out of bed, maybe we'll lower that cadence. That was my takeaway. Then there was Mester, who was speaking almost from the other side. She was saying, we're not taking 75 basis points off the table, though in the near term, that's not going to happen, largely because, as Powell told us, they haven't talked about it yet. And if they haven't talked about it yet, they can't really do it. They're not going to surprise the market, but it's on the table for the future. And when she was asked by Mike McKee, my colleague at Bloomberg, about recession, her answer suggested that it is a possibility that the Fed could push us into recession, meaning she said, completely dodging that part of the question, I'm totally concerned with inflation. So what you have to take away from that is that inflation is such a sticky issue for the Fed. It's such a political issue in the United States now that the Fed has to completely disregard the real economy, and the only thing that will cause them some level of distress is a market that has discontinuities, where they are therefore forced to intercede because they need to clear the market, that the market has become gummed up in a way that is deleterious to the functioning of financial of the real economy.
And the gumming up, what would that look like? Because I think the Federal Reserve a few days ago put out its latest stability report, how stable they think the financial system is. And I'm just reading exact quote, corporate bond valuations, quote, remain high, and that forward price to earnings ratios in the stock market, quote, are still in the top quintile of their historical distribution. So the Fed still thinks that stocks and bonds are overvalued. What would have to happen? What about a gumming up of the works what would that look like in order for the Fed to back off and to have another Powell pivot?
So we can just look at all of the pivots that we've seen before, and that would give you an indication. The last one was March 2020. The one before that was December 2018. I would say arguably the one before that was probably all the way back in 2008. And then you can go back probably to 2000 or to 1998 with LTCM. So it's those kinds of discontinuities where you could have a debt deflation unless they intercede and make financial markets clear. That's the kind of thing that I think that's the only thing that will stop them. So when people talk about the Fed put, and they talk about equities falling out of bed, I think that's not accurate. Really, the Fed put is about credit. It's about financial conditions tightening so much that basically no trades are getting done, and then the Fed has to come in and make it so that the market clears.
Today's episode is brought to you by Bit.com, a leading cryptocurrency trading platform. From spot to futures to options trading and more, Bit.com has it all. So whether you're a seasoned investor or you're new to the game, you need to be on Bit.com. Bit.com has launched a zero taker fee option campaign until May 10th. To enroll, email VIP@bit.com. That's bit spelled B-I-T. So email VIP@bit.com and tell them I sent you. And I want to turn to inflation. Inflation has been hot for well over a year now, and people's purchasing power is being eroded. There's no doubt about it. It's caused a huge sell-off in bonds, long duration equities. I want to get your view. I want to read from the Everything Risk, your newsletter. You say, you used to be a deflationist because you thought that the biggest secular trends, aging demographics and increasing debt, were disinflationary. That limits how embedded inflation can get. But the gargantuan pandemic policy response and the lingering supply chain and consumption changes make me think inflation will remain elevated for years. Tell us about your thinking and how does that change your outlook?
Yeah. So Jack, you have the long term, and then you have the medium and the short term. There are lots of long-term negatives in terms of demographics and high levels of aggregate debt within the global economy that are restraining on inflation. So that disinflation and potentially deflation and debt deflation are problems when you hit crisis periods. But where over the short and medium term, you can get dynamics that go counter to that longer term trend. And I think this is what we're seeing. The level of stimulus was so great, not just in the United States, but globally. And then you add in the supply chain problems that over not just a year, but 2-3 years, you can get effects, hysteresis, so to speak, in terms of that inflation.
Sorry, can you remind me what is hysteresis?
That means that whatever happened impacts the course of events going forward. So there's a stickiness to the problem, so that the problem, like inflation, has become so embedded the transitory inflation has gone on for so long that it actually starts to seep in and create its own momentum for future events. And I think one way to look at this is the way that I look at it, certainly, is in terms of the monetary offset. So a lot of people, they talk about the fiscal side of things, but really, if you're thinking about what's the optimal response to a pandemic or which is unprecedented and shutdowns, probably it's some gargantuan level of fiscal response in order to prevent worst case outcomes, especially in the United States, where where people get separated from their jobs. You don't have schemes where you can have people working and then top up their salary, even if they're only working half time, which is what they do in Germany and the Netherlands and places like that. So that means the people never get separated from their positions, and when the lockdowns are over, they can go back to their positions. In the United States, you had unemployment go up to record levels. So what do you do in those cases? You jam it on fiscally. The Fed's position should be in that case to offset that. That is that here we are in a situation where we're jamming it on fiscally. This gives us the opportunity to have tighter monetary policy. So rather than move with the fiscal authorities, we're going to move against the fiscal authorities. And because they're moving so aggressively, we can do that. And that ensures that inflation won't spiral out of control. The Fed did the opposite. And so that's the reason that we're in the position that we're in. So when I look at the totality of events and I think about what the fiscal response was in the UK, what the fiscal response was in Japan, what it was in Germany, I think that ultimately the fiscal response in the United States was commensurate with what you see in other places, and that wasn't the error. The error was in the monetary response. That is moving in concert with the fiscal response.
And was that a response, what they did in March and April of 2020, rolling out all those programs, expanding the balance sheet by hundreds of $billions in a few weeks? Or was it the fact that they continued quantitative easing and the low rates until long after it was necessary?
Yeah, the second. It's the latter. It's the fact that even after the crisis was over, they were continuing to create money and continue the crisis mode. And so that allowed a bubble to form, and for completely speculative stocks to get a bid, and that distorted the market in ways that we're now appreciating.
So, Ed, what is your outlook on the FANTAMAG stocks? Explain what the FANTAMAG stocks are. A lot of carnage in the speculative growth stocks, but is it really going to drag down the FANTAMAG? And if they do, how much of a sell-off do you think we're going to see?
Yeah, so actually it's FANTAMAN because it's NVIDIA, which is the last N. And I look at the FANTAMAN stocks as the 8 largest NASDAQ 100 stocks, or that were the 8 largest when the NASDAQ first started to sell off in November, at its apogee in November. So the largest were Facebook, AKA, what is it called?
Meta platforms, yeah.
Yeah,
exactly.
Then you had Apple, you had Netflix, you have Tesla, you have Amazon, then you have Microsoft, you also have Alphabet, and then NVIDIA. So that's the whole FANTAMAN. Those are the top 8. And even in the S&P 500, they were pretty much some of the 8 largest stocks. There were only 1 or 2, maybe an oil company like ExxonMobil that outweighed them. So on a market cap based perspective, S&P and NASDAQ, they're very important. And what we've seen is, a one by one picking off of the FANTAMAN stocks. First, we saw Facebook and Netflix, single day massive losses because they missed earnings. And then most recently, we saw Amazon. I didn't think that Amazon was actually the next most vulnerable, but it turns out that they were. I think that Tesla and Nvidia are also vulnerable. And then when you get to the last bastion of FANTAMAN, those are the oldest, the most diversified: Microsoft, Alphabet, and what's the last of the three? I'm forgetting now.
NVIDIA.
Uh, no. It's actually it was Amazon, but it's also Alphabet
Apple.
and Apple,
Yeah.
yes, and Microsoft. Those are the stalwarts. When you start to see problems there, that's when you know it's infected the rest of the economy. We haven't gotten there yet, and so until that happens, I think that we probably will not be in a recession. We may not enter into a panic, a financial calamity. I think that when those last three in the FANTAMAN stocks give way, that's when we have to worry that the overall economy has been compromised.
What about China?
Yeah, China is exporting stagflation, in particular because their zero COVID policy means that supply chains are snarled and it adds into inflation. But at the same time, it lowers demand within China. When people can't go out of their homes to do anything, the net spending is lower. So you have a massive loss of aggregate demand as a result of what's going on in China, and an increase in inflation. And that's being transmitted out to the rest of the world. And that's overall negative. The only positive from an inflationary perspective is the commodity price impact. Perhaps the commodity price impact overrides the supply chain impact. So, you could look at copper, you can look at oil. All of those things are things that China uses in droves. And as a result of the lack of demand in China, there's going to be a price moderation there. So that could actually be over some period of time positive. But obviously, they may have to play catch up once they leave the lockdowns. And so it's not clear what sort of impact it's going to have over the medium term in terms of inflation.
How significant has Russia's invasion of Ukraine disrupted commodity markets? And let's talk about three key commodities: oil, natural gas, and wheat. And so give us your general view. And then I also want to hear, do you think Europe can successfully wean itself off of Russian natural gas and oil, but in particular natural gas, in a short period of time, like let's say a year?
So, when we look at oil as being fungible, even though there are grade differentials and refining capacity is perhaps limited to one particular grade of oil, you can transport it all around the world. Natural gas, on the other hand, you can't transport all around the world unless you have liquefied natural gas that's coming in. And they don't have the terminals in Europe. The United States, in terms of exporting liquefied natural gas, doesn't have the terminals per se to completely supplant Russia. So it's going to be more difficult to deal with natural gas than it is going to be to deal with oil. And then it's to be determined what happens in Ukraine with regard to wheat, because Ukraine's a major exporter of wheat. This planting season has been very difficult. And so we may see over the next year another shock, another inflationary shock as a result of the war in Ukraine. The last shock I would mention is that, given everything that we've been saying, the Russians, they understand all of the dynamics here. And so they may want to preemptively use natural gas as a weapon. So they may preemptively cut off, say, Germany from natural gas in order to inflict damage, because that's their best ability to do so.
Ed, what do you think are the odds of, sort of a global energy crisis happening? Because typically, historically, when the price of oil has gone up, oil companies invest money to build new wells. They go into new countries to dig, and they go to dig overseas wells. But now a lot of them are taking the money that they make and buying back stock, giving it to shareholders, and sort of sitting on their hands. So I know you must encounter this narrative a lot that oil companies are not producing enough. There's been an underinvestment in fossil fuels. What's your outlook on to what degree that underinvestment is, if it is underinvestment, going to create a huge global energy shortage?
Yeah, I think that it goes back to what we were talking about in terms of short to medium term over the long term. When we were talking about debt deflation, it's like the whole concept of peak oil reserves or peak conventional oil reserves. I think that the toggle that we're starting to see now in the oil market is shale. That's what you're talking about, but that's a very difficult structure to deal with because those wells, they deplete very quickly, and at the same time you have the whole capital investment problems that you were just talking about, because we went through that in 2014-15. So I think that it just creates a whole level of complexity in terms of understanding how the market will resolve any shortages, because that market is very volatile. It's not it's not like we can invest there and it will come back and we can keep our investments. Like Deepwater Horizon was a problem, but once they capped the well, people weren't saying we're going to stop drilling deep water. Before that, things weren't suddenly different afterwards. But with shale, I think that after the shale bust, people are looking at it in quite a different way. That we really need levels to be really high before we're willing to gamble with massive capital investment there.
Right. And do you think that high energy prices are a serious risk to global growth?
Yeah, definitely. And so, when you ask that, I immediately think back to 73 and 79. I wasn't old enough to know what was going on then. You weren't born then. And so we can't really say, but my understanding is that they were embargoes. They weren't stoppages. It wasn't that, the Middle East said, we're going to stop producing oil. So in some senses, you could say it was a supply shock in the exact same way that what we're getting now is a supply shock. And yet, the prices went way up. Saudi Arabia, I think they tripled their price overnight, and that's what caused the whole problem. So it's a supply shock. So even though you have a supply shock, it doesn't mean that it doesn't have reverberations that are not just short term, but also medium and potentially long term, especially if the preconditions economically make you fragile and prone to shock in a negative way.
Yeah, that is so true, Ed. A year ago, deflationists and people who were on Team Transitory were saying inflation is supply side driven, with the implication being if it's supply side driven, things will get fixed out because, companies in China, they're not making the necessary products and it's causing a jam in the works. But, in a few months, it's all going to settle itself out. I actually think not only were they wrong, I actually think it's the exact opposite, where they're more than wrong, where supply side is much more serious because it can last for a very long time. If there's a global energy shortage, that could last for 5-10 years. Whereas if it's demand side, all the Fed needs to do is hike interest rates to 3% and destroy demand, cause a little recession, and then, game over. We're good. But what are the implications of inflation that is primarily supply side driven and therefore one that is somewhat immune to monetary tightening by the Federal Reserve?
It was interesting when I was listening to the Fed officials talk about this. And we were having a question within my team, which is the Markets Live team that does the Bloomberg Terminal blog. And the question was, is it a supply or a demand side driven recession if the Fed intervenes? And what the Fed officials have been saying is something of like, we need to get supply and demand in balance. And then you ask yourself, you try to unpack that. What does that really mean? right? Because what they're saying essentially is supply is limited and we need to get supply and demand in balance. To me, that sounds like if supply is limited and demand's up here, we need to get demand reduced to that level. And if you think about the macro preconditions in terms of debt and also the potential debt deflationary forces, interestingly for me at least, you can still unleash those in that sort of situation. That basically they're trying to pancake the level of demand. And then in so doing, potentially they could unleash debt deflation dynamics. And they stand at the ready, of course, with extraordinary measures if that were to happen. But, it's a very dynamic system that we're playing with.
So, Ed, earlier you said you used to be a deflationist. Now you're flirting with being an inflationist. I'm going to put you to the test. So the 5-year inflation break even, what the market is pricing in for inflation over the next 5 years is 2.92%. Do you think it's over or under in terms of what we realize for inflation over the next 5 years?
Yeah, I might have to punt on that because it's hard to say. I have to say because, I think that, as I was saying, we're dealing with a dynamic situation. And I think back when I was at Real Vision, we used to talk about Scylla and Charybdis, charting the course. And I think we're still very much in that mode where you could just crash on one side or the other. It's a very tricky thing and you're being buffeted on both sides, and it could easily just veer off course either way. So if I had to choose, what I would say is over a 5-year period, that there will be an episode that is somewhat debt deflationary, that could get you to those levels. And so those levels aren't necessarily off, but it will be discontinuous. That is that you're going to have a period of above trend inflation falling less quickly than you want it to be, the Fed jamming it on in order to get the levels down. And then suddenly, like that, you have a discontinuity.
And what is going on in Europe with inflation and the European Central Bank? I think Germany's PPI, producer price index, is at something like 30%, a lot of that because of energy. And the ECB is still at negative rates. What are they making plans to hike rates, or are they saying that the economy is too weak? What's going on?
Yeah, I'm at a loss, to be honest with you. I don't know what's going on there. All I know is that they're the ones who are the furthest behind, and it's not clear when and how they're going to catch up and what the outcome is going to be for their economies, especially given the weapon that Russia has against them in terms of natural gas. So whereas you might have said, I wanted to rotate into Europe because basically there was a differential in terms of price earnings ratios, in terms of how attractive those stocks were. And the Europeans at some point were actually performing better. Now you can't do that. It's definitely fraught with risk because it's a much more volatile situation there than it is in the United States. If that can actually be the case.
Yeah. So the ECB, as you say, it's the furthest behind out of all global central banks, with the possible exception of the BOJ, the Bank of Japan. But I don't think they really count because the Bank of Japan is sort of raising their eyes. They're saying, yeah, we're behind, but we want to be behind. We do not want interest rates to rise at all. They're doing yield curve control. And this sort of monetary suppression, hard monetary suppression from the BOJ, soft perhaps suppression from the ECB, let's just call it dovishness, is caused the dollar to explode higher against the against the yen as well as the euro. What do you make of the strong dollar, and how strong does the dollar have to be before it itself is something that worries the Fed?
It's interesting you mentioned Japan, because immediately I was thinking about Japan after we talked about Europe, but from a different angle, and that is why is it that they aren't seeing the same sort of price pressures that when you look at their price levels, it's nothing like what you see in Europe and the United States. I mean, inflation in Japan simply is not the same problem. What are they doing that's different? I don't know. I'm not close enough to the situation, so I can't really say. So I think that is interesting. But if you look at DXY, 70% of it is the dollar yen and a dollar euro. So DXY at 104 or thereabouts now is mostly because of that. And then, of course, you also have the pound, which is getting crushed as well. So the question, therefore, for me, and I think that we were talking about this with our former colleague from Real Vision Max, Weethy, what is the dollar telling us? And generally speaking, I think I agree with Max that it's mostly telling us that there's a differential in policy and in rate policy. And then the question is are we at max policy differential? And what does that mean for the dollar? That's the primary focus. However, as I said, the discontinuities of Fed policy make it so that the whole dollar smile problem does come into play, because as soon as you get a discontinuity in markets, a panic, a crash, a crisis, then everything's going to go towards the dollar. So I think that the dollar on a basis that's because of yield differentials is really close to where it needs to be as a top. So I think that that means more dollar weakness in the future, but then you have the discontinuity that can happen overnight. And in terms of where the Fed is concerned, they're not going to be concerned at these levels. They're only going to be concerned if it goes up beyond these levels, which I don't think it will do, without the discontinuity.
Ed, it's been so great having you on Forward Guidance. Could you sum up your views? And maybe the prompt I'll give you is, why is your newsletter called The Everything Risk?
Yeah, so I think my view is that in 2008, 2009, we moved into the new regime. That was the zero rate regime. And in so doing, we believed that we were in a new era. And in some ways we were, the zero rate, the easy money era. And that meant that the charts for equities, lots of different things, looked very different than it did before. But that era is now over. And moreover, it created a whole host of risks that have metastasized in various ways, even since then, we've had to suppress. We saw that with the European debt crisis. We saw that with the shale oil capital misallocation bubble. We saw that with the repo crisis, et cetera, et cetera. And so now that the Fed is normalizing policy, I think that those risks, a host of them, will pop up in ways that are more difficult for us to maneuver. We had singular risks that popped up that were easier to deal with during the zero rate regime. But now the everything risk is invoking the sense that we're in a completely different era. And that means that those risks manifest themselves in ways that we can't project.
Ed, those of the viewers in the audience, those of us who are lucky enough to have a Bloomberg terminal can find your writings on the Bloomberg terminal by typing in MLIV. But if they want to read the Everything Risk, where do they go to find that?
Yeah, so I think that if you go to the main page of Bloomberg and hit the tab, there's a section that says newsletters, and my newsletters amongst those newsletters. And you can subscribe that way. And, it's free. Which is great. So it's not behind the paywall. Just after we speak today, I'm going to talk about I'm going to talk to my editor about what's on our agenda next for next week. Next Tuesday, every Tuesday it comes out.
Every Tuesday. Ed, my podcast also comes out on Tuesday, so we're competing.
Oh, good.
Well, Ed, thank you so much. Talk soon.
Definitely.